If you've been running numbers on rental properties the past few years, you've probably realized they just don't pencil out like they used to. Between higher rates and higher prices, most deals simply don't make sense, and that's left a lot of investors on the sidelines. But instead of waiting around for rates to possibly drop or for some big market crash that may never happen, I'm going to show you how you can still invest right now and get the best possible returns in today's market by simply adjusting your down payment. Now, I know it's not as simple as just putting more down. Saving 20% is already tough, but the reality is you may still need to increase your down payment savings goal to make a deal work in today's market. So to give some context, when I say a deal pencils out, I'm talking about making a healthy amount of cash flow, enough to cover your monthly expenses and still have a cushion left over. That cash flow is part of your total return, but its main purpose is to ensure you can hold the property for the long term. That way you can take full advantage of the other ways real estate delivers returns, and we'll cover those in a bit. Most people, when running their numbers, are looking for a minimum cash on cash return. Basically the cash flow in relation to the down payment invested. This is one of the main ways you figure out what your offer on a property should be. So I'm going to go through the reasons why putting more than 20% down can work better while still delivering worthwhile returns. Then we'll put it all together by walking through an example deal in my market so you can see how this approach can be applied. All right, the first reason it's okay to put more down is reducing your loan amount improves your monthly payment even more when interest rates are high. Of course, anytime you lower your loan amount, your monthly payment goes down, which helps cash flow. But in a high rate environment, the dollar impact on your mortgage from that reduction is even bigger. For example, if rates were at 4% and you got a $200,000 loan, your mortgage would be at $955. Then if you cut that in half with a $100,000 loan, you would save $478 each month. If rates are at 8%, then that same $200,000 loan would be at $1,400 a month, and cutting that in half with a $100,000 loan would save you $734 each month. So this shows you how much more impactful it is to put more down, especially when rates are on the higher end. The second reason is putting more down will improve your interest rate. The reason this happens is because the more you put down, the less risk there is for the lender. Let's look at another example. So you put 20% down on a $100,000 home and the value of the property drops by 25% to $75,000. If the lender has to foreclose and sell the property, they'll have lost $5,000 plus the cost of the foreclosure and sale process. But if you put 35% down, you would have a loan of $65,000, meaning if the lender forecloses and sells, they would profit $10,000 instead of losing $5,000. Now, usually in this situation, the homeowner would be able to sell this before foreclosure and be able to take this $10,000 after paying off the $65,000 loan. Unlike in this situation where if you sold before foreclosure, you would still owe another $5,000 to pay off the loan. So it's also less of a risk to put more down for the homeowner as well. Now, the interest rate decrease from putting more down is usually modest because it's unlikely that prices will drop more than 20%. The biggest difference comes when you go from 20% to like 30% down, because at that point, it's even less likely that prices would drop more than your down payment. As you continue to increase your down payment beyond that, the interest rate benefit gets smaller and smaller because again, it's increasingly unlikely that there would be that dramatic of a price drop. Here are two rate quotes I got from the same lender. On the left, when rates were slightly higher, and on the right, when rates were slightly lower. This shows how rates scale as you put more down, and that when rates are lower, the difference between the interest rates compresses a bit, which reinforces the same point that putting more down is more impactful in a high rate environment. The third reason why it's okay to put more than 20% down is you can still achieve a worthwhile return. What most people do is run their numbers on a rental property with 20% down, and if it doesn't cash flow at 20%, then they think it's not a good enough return and will just move on to the next. Now, the reason investors stick to this 20% down payment when running numbers is because of leverage. The less you put down, the greater your return will be because you're controlling the full asset with less money. And most lenders require you to put at least 20% down when buying an investment property. For example, when you're able to put 20% down, all the property's appreciation return is multiplied by 5. So if the property goes up in value 3%, you get a 15% return on your investment from appreciation alone. If you put 25% down, it's multiplied by 4, giving you a 12% return. 33.3% will give you a 3x or 9% return, and 50% down will give you a 2x or 6% return. It's a similar effect with the other ways real estate delivers a return. The couple $100 a month you get in cash flow is a better cash on cash return if you put less down. Principal paydown adds up more each month with a bigger loan, and the percentage return is higher when you invest less money up front. And lastly, the tax benefits from depreciation are based on the building's value regardless of how much you put down. So once again, putting less down gives you a higher percentage return relative to your investment. That's why most investors don't think about adjusting their down payment. Lenders require a minimum of 20%, and the less you put down, the better your returns are, so why would you ever do more? Well, the reason is simple. None of those returns matter if you can't hold onto the property long term. And the key to holding it is healthy cash flow. This is where a lot of investors get stuck. Someone might think if I put 20% down, I'll get a 30% ROI. And if I put 35% down, I'll only get a 15% ROI. Then when they run their numbers at 20% down, they realize nothing will cash flow enough for them to hold it long term, so they just don't buy anything. But the reality is you can still buy with 35% down and get a lower percentage return relative to 20%, but you're still achieving the best possible returns in today's market. Because I certainly wouldn't count on the stock market giving a consistent 15% ROI. So if you have money to invest, it's something to think about, because I know you'll get better returns than if that money was just sitting in the bank. And if you truly can get better returns investing elsewhere, obviously do that. But the bottom line is it's always going to be better to put less down if you can make it cash flow. But if nothing is working at 20%, putting more down can still give you worthwhile returns. And then in the future, if rates go down or rents increase, you can refinance back to 20% equity. At that point, you'll maximize your leverage on returns. And then in the meantime, before you refinance, you'll be earning a nice return and be ready to refinance as soon as the opportunity comes. All right, now let's take a look at some example scenarios with different down payments. First, I'll go over some situations in the current market. Then I'll show examples of when it doesn't make sense to put more down, looking at how changing market dynamics affects the strategy. This will also explain why in the past, putting more down wasn't usually recommended. Here's an example of what's commonly available around my market of Richmond, Virginia. You could get a solid 3-bed, 2-bath in a working class area for $250,000. You might just need floors and paint, so we'll put $15,000 for rehab. And a property like that could rent for $2,000 a month. The normal tax and insurance for this property would be $250 a month. Then we'll set aside $300 for vacancy, repairs, and maintenance, and pay a 10% management fee. Here's what that property would look like at different down payments. With 20% down, you'd lose about $50 a month, so you definitely don't want to be stuck with that long term. At 35% down, you need to invest about $40,000 more, but your cash flow jumps to $238 per month, a much healthier cushion. And if you went all the way to 50% down, you'd invest another $40,000, and cash flow would be close to $500 per month. Now let's take a look at what the total year one returns would look like with these LTVs. First, cash flow improves with a smaller loan, about a 3% cash on cash return with 35% down, and around a 4% with 50% down. For principal paydown, the total dollar amount is higher when the loan is bigger, which also creates a larger ROI because you invested less and are receiving more in principal each month. Appreciation in dollars is the same regardless of your down payment, so the less you invest, the better your ROI, and realistically, appreciation would be higher since you put $15,000 into rehab, but trying to keep it as simple as I can. And finally, tax benefits are the same across all down payments, so again, the less money you invest, the better your ROI. So when you add all these returns together, even though the 20% down option lost money on cash flow, the total return would still be higher because you invested less. But negative cash flow isn't a scalable way to buy and hold real estate. Eventually, you might not be able to cover the payment yourself. And if you weren't conservative enough when running your numbers, that shortfall could easily turn into thousands of dollars out of pocket. In contrast, in the scenarios where you put more down, you'd probably still be able to at least break even and continue holding the property long term. Now, I also want to make the point about knowing when to stop putting more money down. There's really no reason at all to go all the way to 50% if you can put 35% down and still achieve a healthy cash flow. In that case, you're just spending more money for less return, and you could have taken that extra cash and invested it elsewhere. The only reason you'd want to go up to 50% is if even at 35%, you still weren't able to cash flow enough to hold the property comfortably. So that lays out a typical situation in today's market and why I think it makes sense to put more than 20% down. Next, I want to show you when it doesn't make sense to put more than the minimum down. And then after that, I'll show you how I apply this strategy when making offers. So let's look at the same example property, but this time, let's say rates are at 4%. You can see now that with 20% down, you're cash flowing almost $300 a month, and the total returns are even more dramatic when putting less down. And the cash on cash return stays pretty consistent across all the scenarios. It's just the total dollar amount that increases as you invest more. So obviously in this situation, there's no reason at all to put more than the lender's minimum down. This is why most people never consider putting more down, because this is how the real estate investing market used to be. Back then, you could easily cash flow with 20% down and take full advantage of the benefits of leverage. I'm gonna go to the Bigger Pockets calculator to show how this applies even if rates are high. If prices are low compared to the rent, the same principle applies. Like if prices are at $150 and rent is still at $2,000, and if I change the interest rate to 8% with 20% down, it's about a 10% cash on cash return. If I do 35% down, and that drops the rate to 7%, it's still about a 10% cash on cash return. So if you can make it cash flow at 20% down, there's no reason to spend more money to get a lower total ROI. Now here's how I apply all of this in today's market. Let's go back to where things are today. The approach I take is if I can put 20% down, I want to see at least a 5% cash on cash return. And that's not because I need a 5% cash on cash return to make the total ROI work. As we saw earlier, I could lose money on the cash flow and still end up with over a 16% ROI. The reason I set it at 5% is because that ends up being a healthy amount of cash flow for these price points. So we know we'll lose money at these numbers. But if I drop the price to $195, you'll see a 5% cash on cash return comes out to a little over $200 a month. So that's the total amount of cash flow I feel is enough of a cushion to cover all of these expenses long term. Now, if 20% isn't an option and I have to put 25 to 30% down, I drop my minimum cash on cash return to 4%. The reason I will accept a lower cash on cash return when I know putting more down causes my total ROI to go down is because a 4% cash on cash return at 25 or 30% down will give me that total couple hundred a month in cash flow we're looking for. And I just showed you even with a 3% cash on cash return at 35% down, you can still make a really strong return. So I'm still happy with my total ROI at this point. Then finally, if I have to put 35 to 50% down, I want at least a 3% cash on cash return. The reason for this is the same as before. If I put more money down, I don't need as big of a cash on cash return because the total dollar amount will still be that couple hundred at a 3% cash on cash. Now at 50% down, I'm also going to change the interest rate. It would be scaling down with each higher down payment, but that wasn't important till now. So the reason at 50% down, I still want a 3% cash on cash return, even though the total cash flow is past the couple hundred I want, is because at this point we've lost so much leverage that I want to make sure the total ROI is still worth it. Because like we said, if the property appreciates at 3%, at 50% down, I would get a 6% return from appreciation. Then 3% from the cash flow, then about a 1% from principal paydown and tax benefits each, totaling an 11% ROI. And I don't want anything below an 11% total ROI because around 10% is what you can get in the stock market. So if I'm not beating that, I might as well just invest there instead. So that's why I want to see at least a 3% cash on cash return and why I wouldn't put more than 50% down either. So you can use this method to figure out exactly how much you can offer on a property while keeping your down payment as low as possible and locking in a solid amount of cash flow. You can also see how much more competitive your offers can be. Remember, the most we could offer at 20% down was about $195,000. In most markets, you're not going to find many deals like that, but if you do, then by all means just put the 20% down. But at 50% down, we could go all the way up to $285 if we really needed to hit that number to make the offer work, and we'd still be getting an ROI better than the stock market. Like I said, a normal property like this is available for around $250,000 in Richmond, so you'd only need to put about 35% down. But this just shows that if the market gets even tougher, you'd still be able to invest and make it work. Now, if you're in a position where even scraping together 20% feels impossible, let alone 35%, you should watch this video here where I go over real ways to buy properties with none of your own money. And as always, if you need any help buying, selling, or investing in real estate, all my contact information is in the description for you.